Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
Okay, Patrick, hit it.
It's August 16th, 2019, episode 41. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. Today we're joined by Charles Hugh Smith from the terrific Of Two Minds blog. And then Patrick and I take a deep dive into the recent GE fraud allegations. For our WTF segment, let's just say Harry goes super bad.
And then for this week's trading history, we go back to August 2015 flash crash, and then we go into our top 5 things to watch next week.
Lena, hop on. Let's talk some beer.
Yeah, so this week we're sponsored by number 99 Rye Lager, Wayne Gretzky Craft Brewing. I'm already slurring my words here.
Yeah.
We've refreshing Rye Lager.
We've started a little early, just for everybody to know. Nothing new to the huddle. And just for those who don't, and actually this was by one of our listeners who sponsored this week's show. Sent us 2 cases. And I have something I have to admit.
Okay, stop for a second, because when you say a case of beer, but let's be
these
realistic,
are craft
a 6-pack.
cases.
Yeah,
these are
they're
craft
6
cases.
packs. Okay, like when
Whatever.
people think cases, they're thinking 2-4s.
So you know what? Yeah, you're right. True Canadian. A case is 24, but this is like the little craft case. Now, I have something I must admit that I did something bad.
What?
I went and I got 6 beers, and I decided I was going to go, and I met Patrick at the Subway, and I gave him his share. So I kept 3 for myself and 3 for Patrick. And I completely forgot about poor Lena. So Lena only gets 1. And I get 3 and Patrick gets 2. So I must admit that I've learned my lesson, and I will not be doing that again.
And you're already slurring, and we know why. So there we go.
Because I was a little early. Let's
So
go
let me
into
read
this.
a little bit from.
All right, so read
from
it quickly. Yeah.
A refreshing rye lager from the Great One. The addition of Canadian winter rye results in a pleasant brew. Anticipate a hat trick of aromas and flavors of citrus, hops, and rye grain. Medium-bodied and flavorful with lively carbonation. Enjoy this with friends while watching the game and pair alongside pizza and wings.
Hey, Patrick, I don't know if it's the Canadian in me, but this is friggin' awesome.
Were
Oh
you
my
a Gretzky
God.
fan?
No, well, I'm not a Gretzky fan. I'm too young
this
for
is-
I actually like Bobby Orr, but anyway.
This is an
this
ordinary
is awesome.
beer, dude. No, it's an ordinary beer. I think
'cause
Wayne Gretzky should stick to playing hockey. This is...
And it's the little bit of rye. I really like it. What do you think, Lena? Now, I must admit,
Really big gulp. It was so good.
this is my 3rd, so I must admit that I'm a little ahead of you guys. So anyways, let's get on to my legal disclaimer. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include jargon aphasia, Mary heart disorder, and or a severe case of the dancing plague of 1518.
The dancing plague. What the fuck is that?
I don't know.
All right.
How about Mary heart disorder? So you got to be a certain age to know who Mary Hart was, and for the millennials, they're just gonna have to Google her.
That's funny. All right. Let's move on. All right. So joining us now is Charles Hugh Smith from Of Two Minds. How are you doing today, Charles?
Great. Thank you for the invitation.
Now, I understand that you've decided to join us by having a beverage. What are you drinking today?
At the suggestion of your staff, I'm drinking beer, and it's a Kona Brewing Company Big Wave.
Nice.
Ale.
I like it. It's a good island beer.
Yeah, very drinkable.
Yeah,
And-
it's actually
and
a
what-
terrific beer.
And what are you guys enjoying?
We've got the Wayne Gretzky's number 99 Craft Brewing Company Rye Lager. So
It's a very Canadian beer. Very
very
Canadian.
Canadian.
Beer.
So, Charles, it's great to have you on the show. I've read your blog for a while and always find your thoughts interesting. So, we invited you on to share some of your thoughts. So what's on your mind?
Well, thank you for the question. And I think what's been on my mind and a lot of other people's minds is negative interest rates, which, as we all know, are upwards of 14 trillion now globally and climbing by the day. And I think we can also toss in super low interest rates, like getting 0.1% on a bond. That's so close to negative that we should throw that in too, right? So,
Right.
what does this mean? I mean, how did we get to a position where after 10 years of recovery or growth, that capital doesn't earn any return? In fact, it's paying a price to be in the safety of a bond. So my kind of thumbnail sketch of that is the system's broken. And so why is it broken? How is it broken? Well, capital in classic capitalism, and I would include socialism, frankly, capital in any system has to earn a return. And if the capital doesn't earn a return, then the system's broken. And so that's where we've come with negative, zero interest rate policies and so on. And so now we're in a situation where capital unable to earn a safe or low risk return has now entered speculative asset markets, right? And so trillions and tens of trillions of dollars have poured into speculative assets. And so now houses in, desirable cities cost $1 million or $2 million. And, we see asset bubbles all in a lot of different markets. And so now central banks are trapped because we've all come to depend on bubble valuations to kind of prop up the whole system. And so we can't let those bubbles pop, but bubbles are inherently unstable. And
Right.
so you can't just keep inflating a bubble forever. And so the central banks are really trapped. And I think that should inform our investment context.
Charles, it's Kevin here. It's what I find amazing about the negative rates is the fact that we obviously have hit a point where monetarism is no longer working. You can't just keep putting rates more and more negative and expect it to work. You see it in Europe, they're falling on their face, yet they continue to talk about lowering rates to, even more asinine levels. If you didn't want money at minus 40, why do you think that minus 60 is going to be the difference? It just boggles my mind that the Germans who refuse to spend, who just to stop and think about it for a second, if the German government goes and actually spends money, if they spent $100, they only have to return whatever it is, 99 or whatever it is. So they could actually, as long as they could spend money without doing something where it was like loss producing, they could actually increase the net worth of their country by spending money.
Yeah, counterintuitive, isn't it?
Yeah, it's mind-boggling, and yet they refuse to do it. And I just wonder if it's you said that the system's broken, and I would agree with you that we've relied on the central banks for too long. But do you think that we're going to get into a point where governments are going to realize that the central banks are trapped, and it will be a fiscal response that we get? And when do you see that might happen?
Well, that's a great question. And a lot of people feel along the lines that you're describing. A lot of people feel that the governments, the treasuries, right, the fiscal side has dropped the ball, right, due to political infighting or lack of consensus or for a variety of reasons, that fiscal spending hasn't carried its share. You can argue that, but then you look at the enormous deficits that countries like Japan and the U.S. are running, and you go, well, wait a minute, how much more fiscal stimulus do you need? And so
Right.
it's that's the fact that we're not being very prudent in our spending suggests that the problem might not be solvable by fiscal stimulus. Another issue that a side issue of this negative interest rates and making everybody pushing everybody into speculation is, what does it do for the standard household? In other words, the 401k, the IRA, the retirement, the decision to buy a house. All these are now basically buying chips at a casino. And so many people were wiped out in the 2008, 2009 crash in real estate and stocks. and because they gambled and they lost. And so it's like that really concerns me as a fundamental issue. Like if it's now impossible for a regular saver to put away money and earn some sort of positive, low risk return, then that's why the system's broken. That's broken right there, because then everybody's a speculator, and then you have to have the skill set of a speculator to survive, and not very many people have that.
Yeah, and if you go look over the last couple hundred years, we've really never had negative rates. So you could argue that this is really unprecedented times, couldn't you?
It seems so to me. And then I start thinking, well, gee, then the past is not really a good guide to the future.
Right, and so all of a sudden, when everyone's playing with a certain playbook, and if we can't rely on that playbook anymore, what's one to do?
Precisely. And so people are looking to, inverted yield curves and a lot of other kind of technical indicators to try to get a handle on what the next 6 months is going to be. Because as we all know, markets are supposed to be discounting machines 6 to 9, 12 months out. And I think the crystal ball is still cloudy. I'm not really sure that you can use any of that stuff.
So would you argue that the market signals that we used to rely on to determine economic policy are no longer valid?
I would say that my confidence level is eroding in those indicators, simply because of the extremes that are currently the state of affairs in the global economy. Like, in other words, just tremendous levels of debt. And markets that are gyrating wildly based on presidential tweets and, a bunch of other stuff that's just really unusual. So, I don't know. Confidence in something that used to work. You can say, well, what else do we have? And I think my answer would be, well, let's just start by questioning everything and really trying to establish whether it's still working.
So, Charles, this is where I want to jump in here and really kind of, I'm going to, you and Kev see eye to eye on some of these different views, but see, for me, I believe we're entering a period of sustained financial repression, where these lower interest rates are just a reality. Like, we're almost all turning Japanese, and that because no one really has a stake or an interest in the system collapsing, we're willing to accept this financial repression to kind of kick the can down the road and keep the system going. And while I think that, you point out the problem with the fact that people are making very little to no return on their capital, I would, at least in my opinion, I still think that doesn't necessarily imply that it is all going to necessarily come to an end in the short term. What's your impression, or what would you push back on that statement?
Well, I would agree with you that, and I think Kevin would too, that financial repression is the key, one of the key central bank strategies, right? And we can kind of go back to the basics of that idea, which is to keep the economy, humming along. Negative interest rates or very low interest rates will push people to spend money rather than save it, because you might as well spend it and get some return in the real world. And so since you're not going to earn anything on savings. And so that, of course, was, I think, intended to be a short-term strategy. It wasn't supposed to last for decades, right? I mean, that's like what you do in traditional economics. You lower interest rates and kind of try to push people out of saving into spending as a short-term boost to get out of recession. And now that's the de facto default policy. And I think what worries me about that is you're basically reducing the pool of investable capital, which in a ideal world is invested in machinery, training, equipment, technology, that it boosts productivity that spreads throughout the economy and therefore boosts everyone's well-being and prosperity. And so if you've stripped the system of actual savings, then all you've got is borrowed capital, right? And so then that's a whole other dynamic. And you've also removed what I would call like financial security from the household. And so now people feel a lot more insecure. They feel more insecure in their jobs, in terms of their income, and they feel more insecure about what they're going to invest, if they have anything to invest.
So, Charles, someone makes you a benevolent dictator tomorrow and you can fix the system any way you want. What would you do?
God, I love that question. Actually, I think my answer would go along the lines of Lao Tzu and the Taoist kind of thought on what's good governance. And at least Lao Tzu of the Taoists, he often counseled that the less you govern, the better your governance, right? And so, I think that we should start by just trying to reduce the sort of arbitrary obstructions and repression that's in the financial system. And that, you can argue about what that could mean. But one possible way to start would be, let's just let interest rates be set by the market. And then if that leads to financial panics, well, then and only then would the government or a central bank step in. And we can look back to like 1907 or previous panics over the centuries as a guideline. But in general, we should free people up to make their own decisions. And then we reset risk, because right now everyone's looking to the central bank to have eliminated risk, and you can never eliminate risk. You only channel it into something that you have lost sight of.
So, Charles, I looked at Powell when he came in. I was firmly of the belief that he was attempting to try to reset the financial system, and he thought that the Main Street would handle higher rates quite fine. But he thought that there was a bubble brewing in the financial side of the equation, and I think that he was trying to stop that bubble before it got going too high. And then he ultimately couldn't handle the pressure. Do you kind of view his actions the same way? Like, do you think that he was intent on trying to stomp out that bubble early?
I'm open to that possibility. My perspective was more that he came in late in the game, nearly a decade into the growth cycle, and there was no normalization of rates, which is, kind of like the term we use for allowing interest rates or pushing interest rates back up to something approaching historical standards, and as a way of giving the central bank some leeway or ammunition, if you will, for the next recession, assuming that that's an inevitability at some point. So he was really forced to try to raise rates as fast as he could get away with to just get something above, 0.25%. And he may have hoped to normalize the entire financial sector, but I think he was probably, in my view, focusing on just trying to get rates up to where he had some leeway for the next financial crisis or recession.
Okay, so Charles, I asked you what you do if you were a dictator and you could control everything, but the reality is that almost nobody can control it, and it's actually in the fate of the market much more than we all believe. So instead of asking you what you would do if you could control the whole system, let's talk about what's going to happen. What you think most likely is how this is all going to play out, and therefore how you would position a portfolio and what you might counsel to people that are worried about the system.
Well, that's an excellent and very broad question. So I guess we can try to start by saying, well, what's the most important things, right? And so I would say one of the most important things is risk, managing risk, right? Because we're talking about a context in which predictions may not pan out and where there's a lot of unprecedented levels and extremes. And so everybody's going to be struggling to figure out what to do, right? It's not going to be some kind of obvious answer. And this is not just because of financial repression, but it's also because we're in the middle of the fourth industrial revolution, and you could count it as the third or fifth. But, it's basically the digitization and automation of the economy. And so this is going to be tremendously disruptive to both labor and capital. And this is part of the reason why we see the winner take most economy that we have now, right? that the gains that have been registered have flowed to a very narrow band of the economy and not as broadly as it is in decades past. And so as investors, it's like, okay, how do we deal with the fact that we really have a high level of uncertainty going forward for maybe decades? So we're going to have to, like, number one, be much more attuned to hedging, I think, and being aware that whatever we've sort of gambled is going to pan out. If it doesn't pan out, then we're going to have to be able to cut our losses or have a hedge in place before something unravels. And so that's, I think, part of why gold and the precious metals have seen such a pop. That's why Bitcoin, despite many claims that it's worth zero and should be zero, is $10,000. Is that people are starting to realize, wow, I really need a hedge here.
Okay. Well, listen, Charles, it's been great chatting with you. Where can people find more about what they should be looking at in terms of potential hedges going forward and learning more about what you write about?
Please visit me at of2minds.com, and there's free samples of my most recent books and huge archives on any kind of financial topic you might want to seek. Okay.
And on Twitter, where can they find you?
Yeah, at CH Smith with a 1 instead of an I. So CHSM1TH.
Well, that's great. Well, thank you very much for joining us. And for those who want to hear more about Charles and his interesting background and his commuting between the mainland and Hawaii, make sure you stick around for the after hours.
Kev, we got to talk GE fraud here. Right? Now, listen, like I was online with my members at Big Picture Trading when I saw the headline, and so I never had a chance to do any homework on it.
That's never stopped you from having an opinion before.
Oh, of course not. But listen, Harry's reputation preceded him, and so I knew him.
Why don't you tell the whole story of what he's claimed and who he is and what's happening?
So basically, he was the one who exposed Bernie Madoff, right?
That's right.
And so Bernie Madoff's entire Ponzi scheme fraud was exposed by Harry, and so therefore his reputation preceded him. And so that now he comes out. You can all go to the website gefraud.com. They even put up a website on it, basically accusing GE of accounting irregularities that basically there's I think he suggested a $38 billion unaccounted for amount of capital or something of that nature. Do you know what the exact accusation was?
I never let the details bother me.
Yeah, no, forget the little details, right? But but the thing is at first it was quite shocking because it's like this guy's got credibility. But it's amazing how many really smart people immediately came out and started defending General Electric, right?
Well, it wasn't immediate. They took their time, but
because they wanted to read what the argument was, right?
Yeah, you don't want to listen. A serious person doesn't just go and immediately say, "Oh, that guy's full of crap."
Yeah, only I do that.
Yeah, well, me too, bud. But it was interesting in afterwards, and especially that night and the next day. You saw some really serious people, Stanley Druckenmiller, the Hampton Capital guy or whatever, I can't remember his name, the Australian short seller. And interesting enough, another short seller came out and defended GE. Who was that, Patrick?
Yeah, and that was Citron, right?
Yeah, and Andrew left.
Yeah, and
not Fred Wright, Andrew left.
And they're obviously they're not shy from short selling something. So if there was a real story behind this, Citron would be hammering GE short to zero if they felt that there was a real story there. And what I'm sharing here on the screen is their whole piece that they put out there, and basically talking about.
Why don't you read it, Patrick? Why don't you read it?
Yeah, but then my reading skills. But anyway,
do you want me to do it? I know you're not very good with those words.
No. But let's those words don't. No, but the point is that he's quite suspect. We'll read just certain parts of this right here. And so the key thing was that says the credibility of Mr. Markopoulos has been questioned immediately when he was asked by CNBC and other media sources as to why he chose GE and why now. And he didn't really have a solid answer. He kind of talked about that's my hometown.
Yeah, he said they moved their headquarters to Boston last year, my hometown. I don't appreciate when you're running a scam in my hometown. What the hell, man? It's Boston. Like no Bostonians are just going to be like, bring it on. Like they're like they're some of the shrewdest guys around. Like I just don't buy that.
Absolutely. And so what does he talk about in this report? Is he basically says it's a very big difference between doing aggressive accounting and fraud. And he said they're two different animals, and that the Securities Exchange Commission has allowed aggressive accounting for years, which has been a helpful fuel to growing the economy. Well, now we can get into a whole argument as to whether these corporations should be juicing their balance sheets with aggressive accounting, but that's not necessarily them doing a fraud or being illegal. It's just them, looking for every little loophole that they can try to stretch to make their numbers look even better, right?
Yeah. Listen, GE has long been suspected of massaging numbers.
Oh,
back in the 90s, they used to hit their number bang on each and every time, and there is no way you hit your number each and every time without
unless you're
being
Bernie
aggressive.
Madoff.
Well, yeah, but the reality is that there's no doubt that GE has used every trick in the book, and that they have gone and been some of the more, sophisticated users of financial accounting to make sure that they hit their numbers. But to claim fraud is another level entirely. Yeah. And what I thought was interesting was yesterday when this happened, I expected there was a lot of guys that started talking about the triple Bs. The fact that this GE is one of the largest, if not the largest amount of credit out there in terms of their bonds, and the thought that if they were a fraud, that this would go and no longer be investment grade and would go down and be a high yield, and then what it might mean to
not
the
a
bond
reaction.
market. Yeah,
not a reaction.
And there was nothing. There was nothing, Patrick. I was shocked that the bond market was like it was surprisingly
brush it off.
Yeah. And the stock market went, and it was it was $9 the previous day. It opened at $8.60. It traded down to $7.80. It closed at $8, so down $1. Pretty ugly. But then overnight, who comes out? Druckenmiller comes out. He says, "I believe in the CEO. I believe that he's actually telling the truth. I bought the stock today."
And it's almost back to 9. It's like it closed at 8.79 or something like that, right?
And so I just look at Druckenmiller. This guy is infinitely smarter than me. He's forgotten more than I'll ever know. And why he has no reason to come out and say that he bought the stock and like to juice this thing. There's nothing. He has nothing but like credibility to lose.
But you know what? It echoes.
And that's how sure he's right.
Okay, I understand that this isn't Herbalife because the float that Ackman took was much bigger, it was like 20% of the float. But this is reminiscent of when Carl Icahn came in and basically called Ackman's bluff, right? That's what Stanley's doing to Markopoulos. Yeah. It's like, the one guy builds his narrative and the other guy says bullshit, and basically now they meet in the market and go at each other, right? And so. What's interesting was that everyone's really pressing this idea that Markopoulos there had a stake in a percentage gain from from a hedge fund that had a big short in GE for publishing this. And obviously, when someone has a financial gain, they're willing to say things embellish things to kind of fear monger a little bit more.
I don't know. It's like. I don't understand why he did what he did. I think it's a little aggressive. They made a website. It seems pretty pushing the boundaries. It seems like they've opened themselves up to a lot of liability. I'll tell you one thing I did, Patrick, like since we're going to be upfront about everything, I saw they cranked the vol.
Of course.
Why?
So why wouldn't you?
Yeah. So Patrick, guess what I did?
You sold some puts.
I sold some puts. I saw,
but you never went less than 30 days, right? Like what? You didn't go long term.
No, I didn't.
Well,
No,
yeah,
actually,
August
this case,
30th,
no. Actually, that's not true. This one I did a little bit of long term, and do you know why? Because I wanted the Vega. Because so in essence, they had cranked the vol, so
Yeah.
I felt like that I should go
You're
and
gonna
sell
want the
some longer.
contraction, right?
Yeah, so I feel
So what
like
did you 3 months?
I did. Yeah, I think I can't remember exactly. I did like some 8s. I think I did 8s, and I did some SEPs.
Ooh,
and
right
some
at the money,
Octobers.
say.
Oh
Look at
yeah.
that.
Like I did it. I think I did. I can't remember exactly. I should know. Maybe I did October's.
Kevin's playing aggressive. I was going to use another term, but I'm realizing this is a family show.
Anyways, I just want to say that that's one way to play it because implieds went up, right? Like they definitely got bid. So I just like, when I start seeing that on something like that. And listen, Druck, I wouldn't have done it if Druck and the Hempton guy from the Australian hadn't come out and said, listen, this is probably bullshit. And I could be wrong. I'm not like listen.
Listen,
you have to be ready to own it. Like it could be a 0 for all I know.
I
but I
believe
think
half
the
of
odds
Wall
favor.
Street. I believe half of Wall Street is aggressive accounting, and I think that's just what's happening. I mean, calling an end to that, and like somehow GE is going to be exposed for that. I don't know. Like that. That's. I think that it might be too broad of a thing.
Not only that, Patrick, you realize a lot of these things was the new CEO addressed a lot of the concerns. And when they had their kitchen sink quarter, like way back when, they a lot of these things that they're claiming they actually dealt with.
Right.
Anyways, I'm just
all right. Anyway,
like,
it'll be very interesting to see how it plays out. In my mind, GE is still a garbage stock without the fraud. I just think that no, but honestly, I think that there's too many problems that they have that they're not going to be able to. It'll take them years to work it off of their books. At some point, every stock is a buy. I just am not. I just don't think that this is the time to be. Look, you sold some premium. Congratulations, you're going to be fine on it probably. But I just think that the big buy on dip opportunity in GE is probably even a year or two away. But we'll see.
Patrick,
All
the
right.
fact that you agreed with my position is not comforting to me.
All right, let's go on, buddy. All right, you have a tale from the trading desk for us. And you've had 2 beers already, so this is going to be good.
This is my third, the Tall Boys. So it might be good. Let's have let's kind of reminisce back to a time when trading desks were fun. Because this is
they have it's a new generation.
Yeah, the banks have no longer been fun, and I'm going to tell you how it was when I was a wee youngin' and I had to go to school with snow up to my chest. No, I'll tell you how it was when I was allowed to trade on a desk, and we'll talk about the Wild West days at, I won't name the bank, but we did a lot of proprietary trading. And so we were actually not allowed to do tax trades. It's complicated. It doesn't matter. But the reality is that we would go and take large positions the other way because we realized that if we couldn't gross up and earn the tax, well, we could figure out ways to arb it the other way. So we would go and we would sell swaps on the Toronto 35 or the Toronto 60 index. And so what we would do was we would go and give people the returns of the index, and they would go and we would have to give them an interest rate component, like an interest rate swap against it. Right. The long and short of it is that we had a huge cash balance that we had to deal with. And so when we had this cash balance, we would have to go and invest it. And I would be stuck with this, and I would phone up our money market desk, and I'd say, listen, I want to do CDOR, which is kind of the Canadian equivalent of LIBOR. And I would go, I had to achieve CDOR on a specific day. So I'd have to, whatever the day the swap rebalanced, I'd have to go and achieve CDOR. And these buggers on the money market desk, they would always, try to chisel me, and they'd be like, CDOR -2. And I'd be like, screw you. This is free money. You should be just taking it as CDOR. And, they're traders, and they would try to chisel me. And I said to my boss, I said, listen, you know what? This CDOR crap, let's just trade it ourselves instead of dealing with the money market guys. So I started saying, I'm going to trade BAX futures, which is kind of like Eurodollar futures for Canada. Next thing you know, I'm tossing around like 1,000 lots of BAX futures because like we got like this big, huge book in this, and we're doing well, and we're no longer getting skimmed by the money market guys. So we think this is great. We're no longer getting picked off. We're getting more efficient. And I say to my boss, I say, you know what? Like, this is like banker acceptance, but like we can do better if we go out and take a little risk. So we go. This is what it was like, Patrick. So we go.
Yeah.
We start buying asset-backed paper, which inevitably in the 2008 problem actually ended up being a real problem, like a real problem. But this was in the 90s and was a long way from this occurring. So I started buying some asset-backed paper because instead of just CDOR, I could go pick up CDOR plus 10, plus 15. And I was like, when you all of a sudden have like we were hundreds of millions. I think we were almost $1 billion swap. So we were, had this credit that we were earning. If we could go pick up 15 basis points, that was real money for us. So next thing I know, I become money market's best customer because I'm buying all this shit. Like you name it, I bought it. Like I was just like, because all of a sudden we had like $1 billion that we had to invest. And so one day, this is going great. We're picking up all this yield, and my big boss is in a meeting. And they're talking about a specific issuer that they are all worried about because it's, I can't remember why. There's probably some fundamental reason for it. But me as a equity trader, I looked at this stock and I go, I'm buying 90-day paper. Look at the stock. It's fine. There's no reason to ever worry about this. Let's just buy the 90-day paper. It's plus 30 or whatever. Let's go. And so he's in his risk meeting, and they're going through it, and they're saying, well, bonds has got $5 million. Money market's got 10. That's good. We managed to sell that. But equity derivatives has 42. And the boss, my big boss, says to me, he says, no, that can't. No, it doesn't say to me. He says to the committee, he says, no, that can't be right. We don't trade that. And they're like, aren't you inventory, blah, blah, blah. And he says, yeah, that's us. And they go, well, you have 42 of this. I think it was New Court Credit, which was a name that eventually got in trouble. So they were right to be worried about it. But, I just looked at it as like 90-day paper. It's going to be fine. Anyways, next thing I know, I get this big screaming like the Flintstones, like when Fred calls for Wilma, and it's Kevin. And so I'm like going and I'm getting all this shit about like the fact that this, young 20-something trader has put all this risk on the bank's balance sheet without thinking about it. And Patrick, I don't blame them. As an old guy now, I wouldn't let some punk buy this, either. But at the time, it seemed like, I don't know what you guys are all worried about. Let's go. So I had all these rules. Patrick. So I was only allowed to buy R1 mid. I was only allowed to buy 50 million, and I had all these rules. And then what happened was 1998 hit. And 1998 with long-term capital, it was just a crazy shit show. And it ended up being everybody was selling futures, and I was buying futures and selling stock, and I was earning credits. And the thing about it is when you're doing this and you're doing this in size, you're actually the rate that you're going to earn is actually really important.
Right.
Well, usually you just let it float in the overnight or whatever, but I went and realized that I could go and I could buy all these credits that were in the previous, they were trading at CDOR plus 10 and 15, but all of a sudden they were trading at plus 50, plus 70, plus 100 in some cases. And I remember them coming to market with $250 million of GE paper. And this is why I like to talk about GE. Yeah. And GE paper, like back then it was like the best, credit that you could buy in credit. Like I think it was the only AAA still. And it was trading at like plus 60. And they were coming to market with $250 million of Canadian paper. And my money market guy phones me and he says, listen, they got $250 million. I said, listen, I'm only allowed to take 50. I wish I could take the whole issue, but I'm only allowed to take 50. And I only could take 50. And but I just remember that it was such a great, exciting time to be alive, and it was so much fun because they just let these young kids like me trade a million crazy shit like this, and it was actually
that doesn't happen anymore.
It doesn't happen anymore. And listen, I don't blame them. As an old guy, I would never let a young punk like me buy all this stuff, but it sure was fun at the time, and we were just minting it because at the like nobody was buying. There was absolutely nobody left to buy, and we had a bank balance sheet, and we were just like minting it, and the arbitrages that were just monstrous, Patrick. And people don't understand when the shit really hits the fan and when the markets get inefficient, how stupid stuff can get on big size.
Right.
Anyways, that's my
because the liquidity becomes a factor, right? And
it's because I was the only buyer.
Well, that's what I mean. Like, it's just that when you're that big of a size,
and the other thing is that I was sitting there as with a bank balance sheet, and I could go and sell vol. And when it went to 20, I could sell it. When I went to 25, I could sell it. When I went to 30, I could sell it. And all the hedge funds were the other way. The hedge funds, they might have sold it at 22, and then all of a sudden it goes to 30, and they all had to cover.
Right.
And I would just be like, I could give it to them every round. So I would just be like, okay, let's just do more. So it's not very smart, and it's one of the advantages the banks have. And obviously in 08, if you started too early, you got completely rammed. And not only that, there was a question of whether those banks would exist. But I just wanted to kind of give a little picture of what it was like being.
Oh yeah, no, that's crazy. Like that's where the TED spreads and everything blew out in 2008, right? Like just banks couldn't trust other banks. It was like a crazy period. But anyway, a kid like you back then in '98 would have no clue.
No clue.
But like long-term capital must have completely changed all that, though, right?
Well, no, that was during long-term capital.
Yeah, that's what I mean.
And those were why those things blew out. But we thought that this was the craziest shit we'd ever seen, and there was no way it would ever happen again. And I'll tell you one thing. Long-term capital was just a walk in the park compared to 08.
Oh, yeah, for sure.
Like, you go look at the TED spread. Go dial it.
Oh, it's ridiculous. Like, it was like 450 basis points or something.
I had a buddy that had a swap with Lehman, and they unwound it. And in the midst of between it settling and the stock settling, they went bankrupt, and he wasn't sure whether he was long or short the stock. And it wasn't just like on 100 million or something. It was a big, big number.
Wow.
Anyway,
well, thanks for sharing, Kev. That was an awesome story.
Too many beers.
Too many beers. All right. So let's move on. This week in trading history. So
Your
Kev,
favorite.
And what I wanted to do was we've gone 300-400 years back in history, but I thought there was a really important lesson to be learned going back to just 2015.
Way back to 2015.
Yeah, like it was August 24th. Now, yes, August 24th is next week, not this week. But just so our listeners, we didn't announce it, but we're actually doing a summer special for the next couple of weeks. So there isn't going to be fresh history lessons during these next 2 weeks. So I figured I wanted to cover it. But it was August 24th of 2015 where we had a little flash crash, and I want to say little because it was nothing like 1987 or anything. This was not like a devastation to the markets and some great story like 1907 or something like this, but it is an important lesson in modern markets. And so back then, what happened was the Dow dropped roughly about 1,100 points in the first 5 minutes of trading, and what was to blame? What was to blame, at least what people initially were saying, was that it was price-insensitive programs. It was all of these programs selling and high-frequency computers and all this different stuff. And the lack of liquidity in the marketplace was driven by twofold, was that, A, these programs are coming in even in the pre-markets and hitting. And, of course, herd mentality and traders seeking protection at any cost were jumping into the markets to try to hedge this out. And this all just became like the animal spirits took a fever over the whole market, and they just hit the bid, right, in huge size with no liquidity. And you were on vacation that week, were you not?
I was at the cottage.
Just checking your iPhone?
Right?
Checking your iPhone, right?
I was probably sleeping in.
You know what's funny is that I was actually camping that weekend up in Algonquin, and
looking for moose.
And we basically were canoeing in that morning. And so we only got to the cars at 11 a.m. And so I missed it all.
Because there's no cell service in Algonquin. People don't realize this, But there's parts of Canada. Well, there's lots of parts of Canada with no cell service, and that's one of them.
Like I honestly got, I was thinking I'm gonna miss the morning of Monday, whatever. I'll be in the car. I could check my shit in the car, and if there's anything, I'll be back home by the market close, right? Like so, I thought, whatever. I'm just gonna miss the morning, and this thing happens. I was like, what the WTF, right? And so. Anyway, let's talk a little bit more about this, right? And so it's all about liquidity. Everyone hears liquidity, but this is a perfect example what happens when there's an imbalance in that liquidity. And so what's interesting is that it all started in Asia and European markets, which drove U.S. futures down about 7% prior to the market open. So the S&P was getting slammed in the pre-market in a big way before the open even happened. It was just the days prior, the Thursday and Friday, the market got hammered 2 days in a row. And then over the weekend, suddenly the Asian market opens and the S&P is 7% down.
7%. Like let's stop and think about that in terms of numbers right now.
Don't make me do math in my head.
No, I'll do it. 28.90.
Like,
I'll do it.
like
I got
whatever,
the calculator
200 S&P points or something like that.
Yeah,
I don't know.
202.
Yeah,
so that's like you wake up tomorrow and the S&P, or on Monday, and the S&P is down 200 handles.
200 handles. That's exactly it, right? And so now Marko Kolanovic over there, J.P. Morgan, came out and pulled up Charlie McElligott and was talking about panic buying of protection as being a driver of this, as dealers with that gamma exposure having to hit the S&P futures in order to keep their books on side. And so
let me explain that, Patrick. If you're short gamma, as it goes down, you become longer.
Yeah.
So as it becomes longer, you have to sell. And if there's less bids, then it causes it to go down, which makes you longer even then.
Right.
So in the summer, when there's no liquidity, it feeds upon itself.
It does. It becomes its own little monster. By the way, if you're listening to this and you have no clue what we're talking about, next week in our summer special, we're actually going to replay that one part where we explain gamma risk and dealer gamma risk inside the show. So you'll just look forward to next week. We'll explain it in greater detail, replaying that segment. But anyway, so let's move on. But the key thing is that they talk about this idea that the animal spirits took over and everyone needed to hedge. Everyone was piling in, created huge dealer risk, and this whole monster became to life like a Frankenstein. And so then what happened here was that what compounded this was that by 9:35 a.m., only half of the S&P 500 stocks were open. So we're 5 minutes. 5 minutes is a long time. I mean, maybe it doesn't when you're listening to the show, but when you're a trader and you're waiting for the market to open.
Whoa, let me interrupt.
Okay,
it's a brutal amount of time if you're listening to the show. 5 minutes is agonizing.
It lasts
long.
forever, right? Like they just can't wait for this one episode to end. This part of the segment. But 5 minutes into the trading session, when everyone thinks the market's already opening at 9:30, it's 9:35, and half of the largest companies in the United States that make up the S&P 500 have not even traded yet. Of something like of the Russell 3000, the 3,000 largest companies, something like 25% of those companies were opened 10% lower on the opening tick.
Right. It was a shit show.
And within the first few minutes, there was some astronomical number like almost 1,300 trading halts on 471 different ETFs and stocks. Just the trading halts triggers, just like boom, halt trade. And so this created a secondary problem that exacerbated the situation, because it became impossible for the ETF companies to actually arb out everything in the ETFs, to value the ETFs, the net asset values of these actual ETFs. So all of the ETFs actually traded at an incorrect price.
Okay, so first of all, it's not the ETF companies. It's actually dealers that make the markets in the ETFs. But you're right. When you don't have quotes and you don't know where the underline's trading, then you can't call a market on the actual ETF.
Right.
And that ends up being a real problem. So you assume the worst. So you bid way lower because you think, well, what the hell? Like, well, I don't know. This used to happen. Like, think about it. If all of a sudden GE was halted and you don't know what price it is, and GE
you're going to assume it's going to be lower.
Yeah. And like this especially, when one stock's halted, it's fine. But when, what did you say? 25% of them were halted or some crazy number?
On the Russell 3000, half of the S&P 500 wasn't even open.
Yeah. So how do you price it? You don't. You assume the worst and you bid lower.
So this is where I want you I'll let you keep talking about it, but I want to show this chart. So on this chart, what we're showing is the QQQ ETF, which is the NASDAQ 100 ETF, versus the actual NASDAQ 100 index. And while on the chart, on the surface, most people think they see the same the pattern, but when you actually do the calculations on a percentage basis, QQQ, which is actually arguably the most liquid ETF after the SPY,
right,
is traded on that morning down 24% on the ETF, when the NASDAQ 100 was only down 17%. But that's not a day over day. That was actually over the 3-day crash. So that's measuring from the start of the Thursday top to the Monday low, right?
And Patrick, the reason for that is because if you don't have the prices and you don't know where they're going to open, what we just discussed, as a market maker, you bid lower.
Right.
So you go, well, at what point do I just want to own this? So you say, okay, the stock, let's assume everything opens down 25%. I'm going to own it there. And that's what you do.
And what exacerbated this whole problem was that a bunch of traders are hitting market orders for this shit. Right? And so you're not even putting limit orders in there. And so there's all this the stock coming at the dealers, and they're just going to low bid it, right?
Right. You just, like, when you're on a dealer desk like that, you just sit there and you'll be like, I don't know where I want to own this, but at a certain point it's dumb, and I'm gonna bid for some. Yeah. And then because there's no liquidity, you get hit, and all of a sudden you're like, holy shit, I didn't know I was gonna get hit. And that's what happened there. And I suspect, if I remember right to that day, there was some stocks that traded at a penny that eventually got canceled.
I think that was 2010. That was I think the 2010 flash crash. Like, a bunch of these stocks went to like 5 cents and 10 cents, and they busted all those trades. Right. I don't think it happened in this one, but that's another history we have to do.
Okay, so Patrick, a little inside baseball for you.
Yeah.
As a trader, you're sitting there and you don't want to buy. You think, oh, I'm going to buy it at a penny because that's great. I'm going to own this like IBM at a penny. Your chances of actually owning that and for that trade sticking is 0.
Right, because they'll bust it.
They'll bust it. What you want to figure out is the level upon which they will let the trade stand. And that is the price you want to own.
And I would argue, if you use 2010 as an example, then that's about, I would argue, about 15-20% below?
I don't know what it is. There's like a lot of times there's different rules. In my day when we used to do interlisted arbitrage, we used to find that the Americans had a different rule than the Canadians.
Right.
So you would have something where once you'd have a fat finger and you would have it go down, and you might get canceled on one side of the trade and not canceled on the other.
Right.
So the reality is that when it moved a certain amount away from the regular price, you actually stopped trading.
Right.
You stopped providing liquidity because you couldn't count on the exchanges allowing those trades to stand.
Yeah. So let's going back to this. What was interesting is that one of the big questions and debates that they had was that because the New York Stock Exchange uses this hybrid model for to open their trading, should they go all electronic the way like the NASDAQ is? It was one of the big debates they had after this crash. I mean, do you think that would have made a difference?
I think that you have to have stops, like not stops, but limiters in there that slow it all down. I think the issue ends up being that when stuff gets a little hectic It goes too fast, and then people don't have a time to react.
That's why circuit breakers are there. And actually, in fact, one of the counter argument to the whether or not the hybrid model should have been eliminated and go all electronic. Some people argue that the first thing that would have happened on this morning's open in 2015 would have been just gone limit down, and the whole market would have hit the circuit breaker right away, and shit would have just been paused right off the bat, right?
See, I think that's what you should do, because the reality is that as traders, what you need is portfolio managers coming up and saying, hey, we're down 10%, I'm going to buy some. Yeah. And that portfolio manager transaction, like the real size, takes a while. Traders react, but portfolio managers take a while.
Right.
And so
if
what
you
you
freeze
need to
the market, and you're basically allowing some of these people with the big money to come in and say, I'm interested, right?
So the millennials in our listening audience won't probably realize this, but the S&P has limits.
Oh, it does. Yeah.
We used to hit them in my day.
Yeah, like that shit don't happen no more, right?
That shit don't happen anymore. You're absolutely right there, because it only happens to the upside nowadays, Patrick.
Yeah.
But the reality is that we used to have situations where they would just slow it all down, and I think that's really important, because having been on a trading desk and seen it, you realize that what you need to do is when the prices get to those extremes, you need to get the portfolio managers involved. They need to be there and say, hey, I want to own that down 20%.
Right.
Instead of it just going down 20, 30, 40 and like no bid, and all the traders just start falling all over themselves.
You know what? I want to now. We have to go back to the 2010 flash crash now, when not today, but when we go back in history, because what was the big thing that happened after after the 2010 flash crash that happened in April? So we have to remember next April to cover it in this session. Was they created individual circuit breakers on individual stocks. Because back in 2010, it was a market circuit breaker, and that's what caused individual stocks. Like I think Procter & Gamble and like a whole series of these utility stocks and other thing all went like 5 cents, 10 cents on like dropping from $60, $70 stocks to literally being almost nothing because there was no bid. And so they what was introduced back in 2010 after that flash crash was this limit up, limit down rules and all of these individual circuit breakers. But we'll save that for another history lesson. What do you say?
Okay. Sounds good, buddy.
All right. Anyway, so it was August 24th, 2015. It was a really interesting liquidity event. And so when you hear people talk about liquidity and you don't understand that when shit hits the fan, liquidity is a coward.
That's right. I don't think that's quite the quote, but we'll go with
it. But I
just
buddy. Made it up right now, like my own version of it. All right, Kev. WTF clip of the week. What do you have in store?
Oh, God. Well, I saw Harry. You pronounce that Greek last name. I can't.
Markopoulos.
He actually, when I saw him, he's not the greatest on camera, don't you think?
He was awkward. Because he's probably lying. No.
No, I don't know about that, but he's definitely. Does he remind you of anybody? Because he reminded me of somebody. Let's hit the tape.
Biggest decline since 2009 yesterday, plunging 11%. The drop triggered by accusations of accounting fraud.
I never see you at parties or anything.
Bernie Madoff whistleblower Harry Markopoulos, I guess we'll play it straight here, told CNBC GE has a $38 billion problem.
Get my brand new fake ID.
Wait, you changed your name to McLovin?
Doesn't even have a first name, it just says McLovin.
This guy's either gonna think here's another kid with a fake ID, or here's McLovin, the 25-year-old Hawaiian organ donor.
I am McLovin.
I've put a lot of people in prison over the years, and I'm just continuing that trend. And I need to get paid. I have a family to support.
Hello, Mindy.
Okay. I'm gonna need to see some identification.
Makes me feel young again.
Anybody who signs those financials as a CEO or CFO is culpable.
So you're coming after the current
management team right now?
On March 7th, they had an insurance teach-in. They could have come clean. They could have shown you the 8 reinsurance deals and what the losses were in dollars and percent. They did not. It would have been easy to do. I did.
Engage.
WorldCom and GE and Enron lasted about 4 months once their accounting frauds were exposed. We'll see how GE does. I think that they're a bankruptcy waiting to happen.
That is bona fide badass.
Don't you think he reminds you of an older McLovin?
Of course. And
like if Harry, like McLovin got a job in the industry, it would be like, Harry.
Harry McLovin.
Harry McLovin. We got a show title right there, buddy.
Yeah, Harry McLovin. All right, I love it. It's good job, Kevin. You have anything to add?
I don't have anything to add
other than if you
how
haven't.
Goddamn good is super bad.
Yeah.
2 good Canadians. We got Michael Cera and Seth. What's his name? Rogen.
No, it wasn't Seth Rogen.
No, isn't it?
No, it was the other guy. Anyway.
Seth Rogen is the Seth Rogen, you idiot. It's definitely Seth Rogen, and Seth Rogen wrote that thing. It's all about it's all about, and he's also in it, and it's also about him growing up in Vancouver. It's a terrific movie. It's one of the all-time classic teenager movies. It's awesome. Patrick, I wanted to work in the scene when Michael Cera was with those crazy drugged up guys, and he had to sing "These Eyes" by the Guess Who. And I just thought it was gonna drag a little, and I thought it wasn't gonna be good. But for those who don't know it, go back and watch that.
Yeah,
it's one of the greatest scenes ever. It's just he's just like Michael Cera is probably one of his greatest roles. One of the greatest teenage movies of all time. Super bad. Watch it. True Canadiana.
There you go. All right, Kev. Time to move on to the top 5 things to watch next week. But before we do, what do? We review the last week's top 5. And so let's jump into this. And so number 5, who was the idiot on the show that went and bought a whole bunch of grains before the crop report?
I don't know who that guy is, but he's an asshole.
He's an idiot. Man, that was shit.
He goochered it, man. He goochered it like somebody, like when they looked up. I'm pretty sure that when you type in goocher to Wikipedia, you see that guy.
Yes. I fucked up. All right, listen. Like, I mean, I had some positions, and now luckily I did actually have hedges in place, but it still doesn't make it feel any better. It's it wasn't like a disaster, but it certainly kind of kiboshed my whole storyline, didn't it?
Yeah, grains are it's just ugly. I love loaning the grains, and they just be nothing but a house of pain. That's all it is, a house of pain.
You know what? We got to bring Angie back on, the goddess of grain.
Well, she probably got it right. She was probably short going in.
You think so?
I don't know. She's pretty smart, man.
Yeah, well,
I will tell you one thing, that talking about House of Pain, I shouldn't joke about it because the American farmer is going through a lot of problems, and unfortunately, it is very, very, very difficult for them.
It's sad.
Right now.
It's so sad.
It is really sad.
You know what? Because you would think that protecting the food supply and those people that are providing that food, that this becomes like an incredibly important part of the kind of country's broader infrastructure, right? And
what, like it's the same in the trading industry, that there's less and less jobs, and it's very difficult. But we're assholes, and they're nice people, so it's much different.
Yes. No, it's true though. Anyway, number 4, copper. Well, you know what? It just hasn't moved yet, but it still looks pretty shit. I mean, this like it's consolidating along its lows. There's at least no sign of buyers bidding it up, right? So right now I'm still a seller of copper. I think that there's no such thing as a triple bottom will hold true for this, and we're going to be south of 250.
Okay, buddy.
You have nothing to say.
I have nothing to say. I listen. I don't want to sell any commodities short, because I think ultimately they're a lot higher. But
I don't necessarily.
In the meantime,
here,
you know what? For a
in
trade,
disclosure, I am not short copper, but I'm not interested in buying it yet.
Okay.
Right. And
I'm not disagreeing with you. Like, the reality is that there is no such thing as a triple bottom. It's probably going to go break down, suck all you technicians in, and then you're all going to be bearish, and that's when I buy it.
All right, there you go. You heard it right there. Okay, so the 2s, 10s bounced off the zero line, at least on
yeah, but you know what? There's an example of a top 10 that actually worked. You questioned whether we were going to see inversion, and we did. We got it, baby. Like, we were actually negative.
Temporarily, at least on this chart, it was very temporary.
But listen, it's better than most of your calls.
All right, but
one second. Quick word though.
Okay.
Do you think that when we got that inversion, that the people sold the stock market, like there was some sort of signals and they just sold stocks because of it? Because I really believe that there was.
You know, it's possible, but I'll tell you that's not a smart way of doing it, because the last inversion was but listen, the last inversion was like 6 months or more. You're assuming
way too much intelligence from most of these market participants. But I hear what you're saying, that it takes a while, but I really think that inversion caused a panic.
Yeah.
I also, you know what? To
it
be
was
fair,
a headline.
I also think it was Merkel saying she wouldn't spend, but that's another story. Let's go to number 2.
Number 2, we talked about emerging markets, and
submerging markets,
submerging markets, and Argentina took the cake, didn't it?
Oh God, shit the bed. I'm pretty sure that's in the.
Well, let's start with the peso, and it gets hammered.
God. Can you do it properly, please?
Oh my! What? Jesus Christ. Okay, so here you go. Are you happy?
Yep.
Okay, so the U.S. dollar rallied against the peso. Okay,
but Patrick, you're like the only guy in the world that quotes it that way.
I think it's so stupid that you flip-flop shit. I always like to put the base currency as the currency you're tracking. It just makes sense.
No, I get it. Listen, Patrick.
But I'm the only one who does it. But I'm the only one who does it.
Yeah.
All right. So the point is that the peso collapses. But what was the big headline was the equity, right? And so let me just pull up the chart on. But here's your Merval.
But you know what, Patrick? I know I saw all these headlines about how this was like a once in a 20,000 year move and stuff. This is bullshit again. I can't stand these moves. Wind it back. Let's step back, okay? So, okay, like really? Like this is what you're getting upset about? The thing's gone from, where are we here? In 2018, 2019.
Oh, listen, it traded. Listen, it traded. Okay, it traded at this price level back in May. So okay,
exactly.
So this was a 1987 style event, which is that there was a melt up in the stock market that happened in the months prior, and it gave the entire rally back in one shot.
I know, but it's Argentina, man. It's not like you're talking about the S&P 500.
Right, but it's
like
still
the shit moves all around all the time.
It's still a big percentage move.
I know, but when they say it's a 20,000 year move, it's because they're looking at the standard deviation over the last 3 weeks.
Yeah, they're
okay, Patrick.
Yes,
Kevin. I got to tap out, buddy. Break.
Well, all right, wait. Before you do, let's talk inflation, and then we'll take a break.
Okay, let's go. Quickly.
So CPI came in flat, but retail sales came in hot.
Sounds good, buddy. You finish it up.
All right. Okay, so the retail sales came in pretty hot, and we'll leave it at that. Let's just go on to the top 5 things to watch next week. So number 5. I wanted to watch what's going to happen here on Home Depot. And so what's interesting is that as a technician, this is actually a pretty classic buy on dip pattern that happens is that it's very similar to, let's say, what happened over here, which is that, it gives back a chunk of the rally, traders buy the dip, and it goes. And so the fact that there's a catalyst this week on earnings is going to be really interesting, whether it gaps it higher. And so that's definitely the stock that I'm watching to see what reactions it has. I don't have a position in Home Depot, but it'll be interesting to see. But that does bring up a thing, Kev, is our bet. So our listeners that are not familiar with this, Kevin and I, back in December of last year, in 2018, made a bet where we're both rock and rolling, but you've still got the edge on me, Kev. But
which is
we
kind
made
of amazing.
It's
the
amazing.
fact is, so I bet on ITB versus TLT, and you
Right.
had the bond market rally.
So
of a
I
lifetime.
said the bond market was going to outperform the home builders. And the long bond was going to outperform the home builders. And this is for the Christmas steak dinner. And
Are you sure? Are you sure?
No, I am positive. I am positive. This was our. I assumed
No.
a
Are you
lot
sure
of
that
things.
Are you sure that you're not winning?
I am not winning because it was as of December 8th. So you have to measure. You have
okay,
to
let me
measure
just
the
let me-
performance from December 8th, and from what I saw, is that the home builders were up like 27%, and the TLT's up like 23% or something like
No,
this.
you're wrong because
What
you're
is
not
it?
doing. You're not doing the total return, buddy.
Okay, what's the total return?
We are neck and neck.
Tell me.
And you are actually up right now.
What?
From December
Shut up.
12th, December 12th of 07, of 18,
Yeah.
to August 16th, I am showing the ITB. That's what I bet on, right? The ITB.
Yeah. Yep.
Total return 25 and a quarter. TLT, I'm showing 25.53.
Oh my God. I can't believe we're both
Because you're doing price change. That's
Yeah,
why.
yeah,
and
yeah.
you are correct here. But that's not fair. We have to do total
Yeah, to
return because
count-
that's
yeah, but
bullshit to not do total return.
I agree. And so
Yeah.
so the bottom line is Home Depot is I think like the fifth or sixth largest holding in that fund.
No, not in ITB though.
Yes, it is.
No, ITB is-
yes, it is.
No, you're thinking XHB.
No. Let me correct
you are.
you here, sir. Let me just pull it up right here. You want to make a bet on this quickly?
No.
Okay, thank you, because you know I'm going to be right. Hold on, let's see. Here we go. So the top holdings right here, we'll use Rob Coyfin's chart there. What is the sixth largest holding at 4.53%?
Good thing I didn't bet. Smart enough to know that. You seem pretty sure that's why you gave it away. You played that really badly, but
I know. I should have been a little less confident. But anyway, Home Depot is a relatively large component. So if it disappointed, which I don't think there's any reason to suspect it will, but if it did disappoint, that's not going to work well for you, right?
no, it's looking bad. I might win that. I might lose that bet. And
No, you know what? The
steak
bonds
dinner.
are not going to hold these gains for the
Oh,
whole
man.
year. I'm not that
Listen,
optimistic. What I need is the home builders to get hammered, and there's no sign of that. I cannot believe how they're holding up through all of
Well,
this.
of course, rates have gone to zero almost, buddy. It's great for the home builders.
Yeah, it's
Well,
crazy.
Like the best days are ahead of them. Anyways, go to number 4.
Anyway, so number 4, I wanted to just we had to. Like, I know we always talk currencies, but how could we not mention the breakdown again in that euro? And we're now once again trading right back down to the lows of the year. And this downwards channel of lower highs, lower lows. This chart looks like shit. And the question is there another leg coming down? I'm just asking the question. Is this a
No.
double bottom?
Well,
you think it's a double
Patrick,
bottom?
No, I don't know, but you just said it looks like shit. You're
It
always
doesn't look
so
like
bearish on
shit.
this.
No, tell me what's so bullish about this chart, dude.
I'm not.
It's cheap.
Listen, I actually don't like it because you know me. I'm short the euro. Sorry, what is it? The Mercedes Jaguar spread.
Yeah,
I love that trade. That's the one you should be doing.
Oh my God.
That's it, man. Look at that one. Dial that one because that's the trade.
But you know what? You've been losing so much money on this.
No, I haven't. Look at it, buddy.
But you're short this.
No, but I waited for the breakout.
Oh my God! So you're
we're-
like
I'm
you
even now.
talked You talked about this trade for months. Don't give me this shit that you just
No, that's not true. Remember
I
said all the hedge funds were short, and I said I'm waiting, and then I said I'm going to sell the breakout.
All right,
sold the breakout.
All right, fine.
Now I'm even.
I'm not going to shit on you anymore. Point is, I still think the euro looks really weak here. And
Patrick, I have a question for you. Who doesn't think the euro looks really shit here?
Everyone thinks, but what
Did you see Raul? Like he thinks the world's ending in Europe next week.
Okay,
he doesn't think they make it to Labor Day.
Okay, but listen, it's the top 5 things to watch next week, and can we not agree that at least we should be watching whether Euro makes the break? Can we agree?
I agree, but listen, Patrick, I have a question for you. Surprise,
yes.
The next surprise Euro, up or down?
I think the Euro's still going lower.
Yeah, I think the next surprise on the Euro will be up.
Yeah, and you said that about the pound and you're losing, and then you said that about the Deutsche Bank and you're losing, and God, your track record is awful. There's no credibility for you whatsoever. Right now, respect the trend for all our listeners. All right, so number 3, flash PMIs, buddy. Like the PMIs are coming right across the board, right? I mean, European PMIs, U.S. PMIs. It's going to be really interesting to see how they all come in, right?
No, they're going to stink.
Right across the board. You even think the U.S. ones will too? I mean, the manufacturing ones will.
Listen, they're going to stink. The economy sucks. That's not like that. That's already in there. Right. The real question is what the market
does to reaction.
That's to me more important than whether they stink or not. They're stinking.
Hey, you know what? There's that old saying that it's not what the news is, but rather how the market reacts on it, and that's going to be a good thing to watch. So it's going to stink, but will the market sell on it?
Yeah, exactly. That's the real question.
Yeah. All right. Number 2, I wanted to talk HSBC. I mean, there's a lot of these different banks we can discuss, but particularly the selling accelerated in HSBC because of the situation in Hong Kong, right? And the stock it dropped from $42 to 36. I mean, I wouldn't call that a Lehman style drop. I mean, Lehman Brothers is dropping like a rock compared to this, but HSBC, this is for a big established bank like this is a pretty big move, right?
I don't know, Patrick. Come on, let's step back.
Oh,
it's not good, but it's not the end of the world. The real question is, does it get worse from here?
That's what we have to ask. Does it? It's very oversold. I won't get. Look, if shit doesn't hit the fan on Monday and Tuesday or over the weekend in Hong Kong, then we could see a short-term low. But I mean, that's a big bet. That's a big bet.
I'll give you a trade.
Things could get pretty ugly.
That one of my coworkers brought up here, and I wish I had done it. He told me maybe a month ago, maybe even longer, 2 months ago. He said, you know what you should do? You should buy Singapore, sell Hang Seng. And the trade has been on fire. It's been one of the greatest trades ever in terms of it's just going one way. It's actually a terrific trade. I wish I almost feel like I should still do it because I feel like that a lot of the things that are happening in Hong Kong are very bad for the long term, and that there's a good chance that Singapore will benefit from all that. But I don't know anything about it. Not that stopped me from doing a trade before, but I just feel like it's in another time zone, which really bothers me.
By the way, so we don't make very many, other than me assuming we make a lot of steak dinner bets.
Yeah, I know.
We
you
clearly, in my mind, we make at least 3 to 4 times as many than we actually really do. But
you only consider the steak bets the ones that you're up on, and then all of a sudden they get revalued in your head.
So we did definitively make a bet on Deutsche Bank for a steak.
Yes, we did. For sure.
And the moment you made the bet that 5 or 10, which one's next? Deutsche Bank literally in the next 2 weeks after you made that bet drops nearly 20%.
Really? When did we make it? In August?
Like 2 weeks ago.
Really?
It was just we just literally made the bet when it was like at 780. And the moment you opened your mouth that you think 10 before 5, the thing nosedives. Now, obviously, got a little bit of a pop today in the whole market. But listen, I'll tell you what. I'm going to let you out of the deal. You can right now.
I don't care. I don't even care. I think I'm still going to win.
Okay.
Well, actually, I should listen. What are you offering? What are you offering? Because you might offer something.
You could just buy. I'm just saying you could just buy me a keg steak. Otherwise, if this hits 5, I am going to go Wagyu on your candy ass. For
people who don't know, Keg is a Canadian kind of cheesy restaurant. It's kind of like going to Outback Steakhouse. And Patrick's letting me off with a cheap one. I'm sticking tough. I'm doing it. You can do Wagyu. I don't care because I'm gonna win.
Oh my God! All right, well, fine. Let's see what happens. All right, number 1. I'm gonna let you take this one, Kev.
Jackson Hole. It's a big deal. All the central bankers get together in Jackson Hole, Wyoming. Have you ever been there, Patrick?
No, I have not.
Actually, I have. I went in 1986. We drove to Expo, and we went through Jackson Hole on the way. So I was just there briefly. I should go. It's a great skiing destination. It's one of the greatest ski hills around. It's kind of one of those you have to do it.
Yeah.
But anyways, we're off track. They all go to the central bankers all get together in Jackson Hole. And this is a chance for them to make some history. I think that Bernanke did some famous QE there. I can't remember which one it was, but he announced it there. There's been a long history of them changing policy.
Do you think right now that Powell takes back the fact that this is a mid-cycle adjustment?
Yes. For sure.
Okay.
I honestly believe that he wants out of the headlines. If he was smart, he would go, and Patrick, you're going to think this is crazy. He would go and lower rates more than the market is expecting and walk away. That's what I would do. So if they're expecting 50, I would do 75. If they're expecting 25, I'd do 50. I would just do it to get ahead of them because, unfortunately, by chasing the market, you're just making it worse. And we had Barton on the other day and explained to us why the fact that T-bills were trading below IOR, ER was a big deal. I tend to agree with them. I think that there's a lot of funding and crazy stuff that's happening that way. And I think that just chasing the market down isn't doing enough. He's got to go out ahead of it.
What do you think would happen to the 2-year if your scenario played out?
Oh, it would be like instantly bid, but I think the long end would sell off.
Yeah, there would be a steep
I think you could have a situation where the 2 years up, whatever that works out to, and the long end sells off. That's how, like, if he was actually smart, that's what I think he would do.
Yeah, and all of your steepener trades would come in, right?
Yeah, I know. So I'm not trying to talk my book at all. No, but I definitely, I'm sympathetic to this idea that following the market around, you're just getting we had that WTF video where I got in all sorts of trouble and people told me I was a sick, weird guy for what was it? The
Game of Thrones one.
Game of Thrones one. But Powell's been neutered and he's just like the market and Trump are leading him around and he's got to show them who's boss. And I really think that just following the market around is not accomplishing anything. Either that or say
so. Let me let me ask you this question: what if nothing happens at Jackson Hole and he stays firm? Does the market get hammered?
Yes. Oh yeah, for sure.
Yeah,
because I think that Trump is playing the game and he wants the rates lower.
Yeah.
And he's going to continue to pressure. And not only that, if Powell does that, he's just walking into Trump's trap.
Right.
Trump is going to blame the entire recession on him. This is why I'm saying that Powell's got to go out and do more than the market is expecting.
Yeah.
He has to get ahead of it.
Well,
I really think he does.
It won't take us more than a week to find out, won't it?
Yeah. Listen, that's what I would do. I don't think he's going to do it.
You don't think so?
No, I think he's going to do the bare minimum. But I do think he's going to do the bare minimum. I think he's going to try real hard. He's not one to rock the boat. I think he's just not. He doesn't have the kind of the guts to go do it. If anything, I think you're going to find that there might be a change of policy more in Europe than the U.S. And don't forget, this might be a sign of a chance for all governments and central banks to get together and just show they're serious about reflating.
Yeah.
And Patrick, we haven't spoken about this. You've been busy, but I've been keeping my eye on the Bloomberg. They recently, I think, Mnuchin, when he wasn't frolicking with his wife, he actually announced that he's going to look back at floating the 100-year, the ultra long bond.
Really?
Yeah.
Huh.
1 hour ago, I'm just looking at the Zero Hedge, your go-to source of information here.
Hey, Charles gets picked up on Zero Hedge, and so do you.
I know. They publish this idiot called Macro Tourist. So how smart can they be?
They can't be that.
Yeah. So let's just look here. I think interest rates are going to stay relatively low for the next couple of years, Mnuchin told CNBC. We'll look at potentially extending the maturity of the debt because eventually we're going to have higher interest rates. And that's something this country is going to need to deal with.
Right.
Asked if he would consider maturities of 50 or 100 years, ultra-long issuance has become increasingly popular in Europe. Mnuchin said, we'll take a look at everything.
So you think that happens there?
I don't know. I just listen. If I was me, I'm bearish. So I would be selling everything I can. I would be hitting every bid that I could. Really over 100 years. What would a 100-year trade at? Let's just look at this. 100-year in Austria is trading what? Like a 160 or something? I can't even remember.
No, it started at 160. It went under 1, didn't it?
Yeah. Okay, so Austria is not the right case but let's just look at U.S. So the longest bond in the U.S. is what, 30? So the 30 is trading 2%. So let's add another what? Maybe you know what, Patrick? There's a chance that because people have such a desire for duration that it barely trades above 30.
Okay.
So let's say it trades 2.25. Do you really think that over the next 100 years that's not going to be a great trade?
Stop for a second. Over the next 100 years, but what about the next 5 years? It doesn't make it a good idea. You've been freaking early to this shit all for the last...
No, but Patrick, if you're thinking as a government official, you should be selling... If you think that there's going to be 5 years,
they should be.
They should be selling it this year. They should be selling it next year. They should be
issuing
issue.
Oh, yeah. Oh, I'll agree with that. They should be selling as much of it as the market can pick up.
When the ducks quack, you feed them, and the ducks are quacking it literally seems like a Ducks Unlimited conference this weekend. All you bond bulls are going bananas. I would be pasting every bid I can imagine. Anyways, let's go on. That's it. We're done.
Well, we're not done. Well, first of all, parting words of wisdom.
Oh, my good buddy Jawad. He actually tweeted something out the other day, and I thought it was so wise. And he's a super nice guy. Have you ever met him?
No, I don't think I have.
Oh, Jawad Mayan? I don't know how to say his last name. Super nice guy. Really, I can't remember what his name of his blog is. Just Google him. You'll see him. Super nice guy. He's actually, I think he's from the Mideast, but he actually lived in Canada for a little while.
Right.
He came and went to school here. Anyways, really nice guy. He's been on Real Vision a couple times, and he says the biggest risk we need to manage is ourself.
Yeah.
And Patrick, I've seen both you and me after a few beers, and I agree with that.
All right. It is words of wisdom. You do have to actually manage yourself. I'll agree with that. With that said, though, we need a quick announcement. And we should have done this at the beginning of the show, but we'll do it throughout the next couple of weeks. But we're doing another Market Huddle meetup.
Yes, that's right.
Right? And so it's a new venue, but it'll be in Toronto. So the occasion is that there is the Toronto Money Show going on, and I'm going to be speaking at it. But so will Chai Girl, right? Tracy.
Yes, that's right, Tracy.
And so those of you that follow Tracy on Twitter, and enjoy
listen,
her,
almost everyone does because what does she have, 40,000 Twitter followers?
Oh, more than that, and more than us combined times 3 or something. I don't know,
no, it is.
She has anyway. But she agreed, and she actually was the one who proposed it, and that we should have a big market.
Don't stretch the truth there. I don't know if she proposed it. I think she wanted to go. I think she wanted to go with us, and then we were like, "Oh, we're grabbing our listeners. We're bringing everybody."
Right.
We're
And
like,
so,
like when you get invited to a party and you bring all your pals.
yeah.
So
And so,
poor Chai
anyways,
girl's
it's an open invitation for all of our listeners that are willing to be in Toronto on Friday, September 20th. First of all, it's free to go to the Money Show. And so anyone can join us at the Money Show itself. But afterwards, we're going to do a Market Huddle meetup. And again, it's free. And, we just need you to show up and have a great time. We had a great time in Chicago, and the last one we did in Toronto, that was like 6 months ago or something. But we'd love to see all of you again. All of you that came out to the Toronto one, please come out again. That was great meeting all of you. But we'll have
For
a great
sure.
time.
And not only that, we actually have a star this time because we have Tracy.
Yes.
So you don't just need to look at our ugly mugs.
Right, and
listen,
more importantly, Lena's coming.
Oh, that's right. Lena's coming. Lena, get on.
Lena is coming. She's going to behave, but Lena's going to be out there as well, and so will Luke, and it's going to be a great time, right?
Are you looking forward to it, Lena?
Oh, I'm so looking forward to it. I was kind of sorry that I missed the one in Chicago.
Actually, that is true. Lena was sorry that she missed the one in Chicago. She was the only one. She was busy doing all the real work and the editing behind the scenes that making us sound good. Although in Patrick and my case, it's very hard.
Anyway, by the way, it's not RSVP, so you don't need to let us know. Just show up. It's very simple.
That's right.
Just show up.
Friday, September 20th. It's at the Rec Room, which is downtown Toronto. Everyone's invited. Don't worry if you don't know anything about the markets, neither do Patrick or I. And come and chat and drink some beer with us and Lena and Chai Girl. It's going to be a lot of fun.
And Lena, if you can take a snag of the screen and just include it in the email so people will see it as well, so they can see the address and information on there. Anyway, that was a good show, wasn't it, guys?
It was great. Okay, so Patrick, where can they follow you, buddy?
Oh, yeah, you can follow me at Patrick Ceresna on Twitter, and as well, you can just go to bigpicturetrading.com. How about you, Kev?
I'm at Kevin Muir. Make sure you sign up to the Market Huddle so you get all the great content and you get informed about stuff like the Friday, September 20th Rec Room Market Huddle meetup.
Nice.
And actually, Patrick, before we do anything, we should tell everyone that we are taking a couple of weeks off.
Yes. So our listeners, you'll still get content, but it's just not going to be as fresh. But for next week, what Kevin and I are going to do is we're going to do a bunch of our excerpts of our absolute most favorite clips. And it was so hard. There are so many amazing guests
Patrick,
we had.
mine was really easy. I just took that one where you weren't there. All mine were from me and Tony.
Oh, my God. Anyway, so we're doing all of our favorite clips. And so we're just going to put it together in a little show. It's still going to be, an hour and a half. And it's just all of the best clips, all the best looking back. And then
we're still figuring it out.
Everyone.
Don't say anything. Yeah. We're still, the last week of August, we're still figuring it out. But we might have something special. We'll see how it goes.
Then we're going back to our normal format in the first week of September. So
that's right. And actually, we have a blockbuster lineup signed up for September. We've been looking forward to it. It's going to be a great group of guests, and make sure you stick around.
All right, perfect. Well, thanks everyone for joining us, and enjoy the rest of your weekend.
Take care.
Charles. So welcome back to our After Hours, and we obviously had a great conversation with you earlier in the episode, and I want to continue that. But before we get there, I wanted to just touch on the fact that you're someone that has traded, but you live in Hawaii, and I wanted to know, how do you follow the markets in that time zone? Like how is that for you, being out in Hawaii and keeping an eye on what's going on in the world out on at least on the East Coast?
Yeah, well, that's thank you for the question. And yeah, in Hawaii does not have daylight savings time like the mainland, and so the time difference between the New York and Hawaii changes by an hour, depending on daylight savings. So when it's a 3-hour difference to California from Hawaii, which is kind of the standard, then the market opens at 3:30 a.m.
Right.
It's like the worst. It's the worst time you could ask for. Like it's almost like the most. Like I love Hawaii, Charles. I think it's the greatest place on the planet. I think it's just it's wonderful. But you if you said to me, what is the absolute worst time zone to live in? I think I would choose Hawaii.
Yeah, in terms of being a day trader or really having to focus on markets, yeah, it's a bit much. I mean, in Honolulu, in the the more expensive homes are in the hills, and so that's where my brother and sister-in-law live, and so you hear the Beamers and the other the brokers and so on coming down the hill at 3-4 in the morning.
Really?
But
They honestly they get up and they go to work.
Yep. They have to.
Wow! I didn't know that. I had no idea. Yeah, like when you used to see a Bill Gross on TV looking haggard, getting up at 4 a.m. to do it from the West Coast. That's nothing compared to these guys.
Yeah, and I guess I'm not so much into day trading. So on occasion, I will, if I really want to get a trade in the first half hour. And the old rule of thumb, you don't trade in the first 5 minutes. Let the market bubble along for at least 20, 30 minutes, right? So I sometimes I'll get up at 4, but that's rare. And most of the time I'm kind of a long-term guy, so I try not to get whipsawed too much by the daily stuff. But yeah, it would be brutal if you were trying to day trade.
But the advantage on the other side, though, is that the market closes for just after breakfast for you, and then you're basically free for the rest of the day, right?
Yeah, you lick your wounds for like a half hour till 10:30, and then you go, oh heck,
So Charles, do you live on the Big Island?
Yes, I do.
Okay, so I actually love the Big Island. We went and climbed into the volcano, and it's just a wonderful place. I think it's the only place around, or it's one of the few places that has all 5 out of the 7 climate zones in one spot. Is it something like that?
Yeah, that's right. Yeah, there is snow on the big volcanoes, or you can just go down and I'm glad you went to the volcano. It's been active, as you know. It stopped now about 6 months ago, or maybe more. But yeah, it's lively.
People don't realize it, but actually Mauna Kea, or if I said that right, is actually taller than Everest. And everyone says, oh, whoa, that's not right. Everest is so high. And it's like Everest is higher, but it's not taller. So if you look at from sea level to the top of Mauna Kea, it's actually that distance is higher or larger than the Everest.
Yeah, that's right. Measured from the bottom of the seafloor. Yeah. So, well, I'm glad you got to visit Hawaii. I know that's a long haul from Toronto.
It sure is. Okay, so let's talk a little bit markets. We've probably had enough of, everyone's going to be jealous of you. We don't need to hear any more about living the good life in Hawaii.
It's hard. It's really hard, though. I mean, there's no extremes of temperature and stuff to keep you alert, so.
So, Charles, I wanted to actually talk to you a little bit about this. You've written about it before, about deglobalization and this idea. One of the big trends over the last 20, 30 years was moving to globalization, and so now that trend has seemed to reverse. What's your feeling about how this is all developing?
Well, that's a great topic, and I want to comment first and just appreciation of your guys' informality and the range of topics you're willing to discuss. I find that really refreshing. So the way I look at deglobalization is there's a couple of different factors powering it. One is, of course, the eclipse of the nation state, and this is where the so-called populism and nationalism is arising as people are starting to realize the nation state serves a purpose because its ultimate purpose is to protect its citizenry, right? And so globalization sort of acts to erode that nation state concept, right? Because it's all supposed to be open borders, and capital has no borders and serves no masters except the owners of capital, and so on. And that's great in a sort of boost phase, if you will, of capitalism or global capitalism, in the sense that a lot of places like China, why was China poor? Okay, they had, really poor policies, but they were starved for capital, right? And that was true of the Asian tigers and many other nations, right? And so when you open the borders to capital, you suddenly get capital that can be invested productively in these capital-starved economies. And then you get this really solid, broad-based growth that everybody loves. Everybody's making more money. It's a self-reinforcing cycle. But when you get to extremes of global capital, then it starts becoming dysfunctional, right? And so then you start getting exploitation and other bad effects. And that's where we've seen in the States, where there's a number of people, I think less so in Canada, but certainly around the world, the idea that globalization has cost us jobs and it's stripped away the middle class and it's created or added to this winner-take-most economy. So that's part of it. And I think also that I often refer to a chart, the S curve, which often describes natural systems like the infection rates of a bacteria or something like that. And what it is there's this boost phase, the part of the S, and then stuff rises very quickly, and then it kind of tops out and stagnates, and then it declines. And so that's kind of what I see as the return on globalization has now decayed to where in many cases it's now negative. So it's really not making financial sense anymore.
Right. And so I wanted to move on because, earlier you touched on asset prices and negative interest rates. And one of the reasons interest rates have been able to been maintained at such low levels is that there's been very little to almost no inflation. And in fact, some would argue that there's natural deflationary forces in play. But how do you think this plays out in the bigger picture? Because I know Kevin over here believes that there's a hidden inflation that will emerge at some point, and it's going to wreak havoc on everything. I don't want to put words in your mouth, Kev, but I think I'm pretty right.
That's fine. I agree. I just don't like the hidden part, but otherwise I think
well. But on the other hand, those people that are, see this massive amount of debt and the fact that so many people have to service this debt, especially a lot of overtapped consumers, that this has them spend less, and it's actually a natural deflationary force within the system. So what's your take on inflation, deflation? How does this play out in your mind?
Well, that's a terrific topic, and I'm glad that you guys have you've kind of covered both sides of it, because, we've all had this same debate for 10 years, right? I mean, or 15 years. It's like, well, why, which is going to win, inflation or deflation? And how come we don't have inflation despite all this fiscal and monetary stimulus? And of course, we all know the general answer is, well, we do have inflation, but it's in asset valuations, right? All the money that's been printed or borrowed has flowed into, or much of it has flowed into assets. And so that's why we get these crazy valuations of, Beyond Meat and, any house in the Bay Area here in the San Francisco Bay Area is, worth an absurd amount of money, at least on its market valuation. And so we have had inflation. It's just been pouring into assets where this speculative bubble mentality that I've described as the result of zero interest rate policy. So that's one answer. The other answer is the authorities are purposefully understating inflation. And, we all know that if you use hedonics and a variety of other kind of trickery, then you can really underestimate inflation. And one of my favorite tricks that they use here in the U.S. is they have the basket of goodies that are in the CPI, the Consumer Price Index, right? And so what they do is they minimize the size of the sector. So healthcare, which is roughly 19% of the U.S. GDP, right? I mean, it's on the order of, I don't know, 3 to 4 trillion. Well, it's something like 6% of the CPI. Well, it's like, well, wait a minute. It's like, how did they figure that? It's 19% of GDP, and it's like some trivial amount of CPI. And they do the same thing with higher education, right? In other words, if people are actually paying for college, it's a huge hit. It's a huge percentage of their income and spending, and yet it's some trivial percentage of the CPI. So that's why I think more rational, estimates of inflation are more on the order of 6 to 7%, not 1 to 2 or 3%. So that's the
Charles,
other answer.
Yeah, Charles, I just want to, sorry to interrupt you there, but like the other thing that I find crazy about the way they adjust those is they'll say something like your iPad is twice as fast. So therefore, it's really gone down in half value. Or they'll look at the average car. The average car used to have, I don't know, 200 horsepower. Now it has 300. I don't know what the numbers are, and they'll say your car is a half better. And
right,
you're just like, what?
And also, Kev, they'll do things like substitution. So if the price of steak has gone up, they'll say that you get the same utility out of ground beef, and they'll substitute like something that's equivalent into the basket, even though rather than tracking just the one item. So it is a political vehicle, like the calculation. But what's interesting about it is that, like, when I was speaking with like Russell Napier, he was saying that the problem is that that's what we use because it's got the longest history behind it. It's like there's no real acceptable academic way of measuring inflation that they have a large data sample for, and so everyone just keeps sticking with CPI, even though everyone at the academic level accepts that it's a flawed measure of inflation, right?
Right. Of course, as you guys know, there's other attempts, right? The Million Price Project of MIT and so on. Well, let's talk a little bit. You mentioned the iPad and stuff like that. So let's talk about technology a bit. I'd like to hear what you guys have to say about this because, technology is generally enormously deflationary, right? Because everything does get faster, better, cheaper. But as you guys raised the subject, automobiles, for example, are a perfect example that there's more chips in a car now than there is in a computer, right? I mean, it's got way more semiconductors, but the sticker price to the consumer keeps going up. So it's not cheaper. It may be better, but it's not cheaper. So is it deflationary or not? I mean, how do we measure that?
Yeah, I don't think it is. Like, I think that's bullshit, and it's keeping the CPI down much more than it should be, and that really we're experiencing way more inflation than we would have ever guessed. And when you go look at the shadow statistics and stuff, there's a fellow that keeps I can't remember the fellow's name, but he just says let's just leave the system as is, and we'll use the way we used to calculate CPI. And if you do that, I think we're running 4 or 5%. And then if we do that, and if you use the real number, you'll realize why the current financial system and where we have interest rates set is so financially repressive. Because
Absolutely.
in real terms,
it's the theft of capital.
Yeah.
Yeah, exactly. Well, let's I on the same kind of topic, I'm curious what you guys see happening to employment and household income, because we all know inflation is running hotter than the official statistic, and yet wages are the one thing that's not going up, right? For like something like 90% of the people, right? Or 80 to 90%, right? When we compare like the past periods of inflation, such as the 70s, wages were going up lockstep, right? And for the last Go ahead.
But wasn't that, Charles? Sorry to interrupt, but isn't that a function of globalization? Like, you go look, we had two huge things occur in the 90s, which was one, the fall of the Berlin Wall, or late 80s, and then also China, entering the WTO. Yeah. Both of those were huge supply shocks to labor. So all of a sudden we had, hundreds of millions of people competing for, on the labor side. And then we wonder why there's no wage inflation. Well, the reality is that though there's been a huge increase in supply.
And also you have to add the technology to that, where, as soon as you start putting wage pressure, there becomes an increasing incentive for businesses to find technological alternatives to paying higher wages, but rather making everyone more efficient and needing less labor.
So,
right?
Patrick, I don't buy that argument, and I'll tell you why. Because everyone's has been saying that for hundreds of years. They used to say that about whatever it was they were building at the time. And the reality is that jobs will change, and you need to make it so people can change. But to say that we shouldn't continue to make our economy more productive through technology because it might.
I'm not
cost
saying that,
somebody
but I'm just saying that that's definitely one of the drivers as to
I
why
think, though, a proper
we have not
functioning-
seen.
Yeah, but a
wage inflation.
properly functioning economy should just have, you should retrain that worker, and there should be a new job that opens up for something else. And so I'll give you an example. Everyone goes on, I see on Zero Hedge, they talk all the time about the McDonald's kiosks that are causing all sorts of teenagers from being laid off. I spoke to the McDonald's up in my cottage country, and the lady that ran it, the manager, told me that she said they'd never been busier and they had to hire more people because the reality is the people preferred to come and go order from the kiosk because there's a higher chance to get the order better. And so they actually found themselves busier and were hiring more people. So I think it's a very slippery slope to just say, oh, this is going to cause, the computers are going to replace people and therefore there's going to be less jobs. I think we just have to work a little harder on figuring out how to make the society more productive on the whole.
Kev, I don't think that anyone disagrees with you in that sense, but I mean, ultimately there has not been any wage inflation, and so the question is why not?
But it's back to my thing. I think it has more to do with China and the fall of the Berlin Wall. But Patrick, you and I are arguing. We should really ask Charles what he thinks.
Well, I'm loving the exchange because I think that's what you guys have each proposed is like critical context, right? And so I would just kind of add that that we have to bring capital into the picture. And so when capital is really expensive, like you got to pay 10% to borrow, then you're going to go, well, gosh, maybe I can train this worker and increase productivity that way. That's the cheaper alternative. But when you can borrow for a 1%, then you go, well, I'll just throw this money in automation, And so I think there's that element of it, and the between capital and labor being productive with super low interest rates, capital now has the advantage, right? Because if you're in business, then you'll go, well, gosh, if I can replace some labor with some automation that I can buy at basically zero interest, that's going to be more attractive than if I had to pay 5, 6, 8, 10%. I want to raise another topic. Related to this is like there's an economist who won the Nobel Prize, Michael Spence, and I think one of the reasons he won the prize was he talked about tradable and untradable labor, right? So that and what globalization affects is the tradable stuff, the iPads and so on. It doesn't affect the McDonald's that we're talking about because you can't get the McDonald's hamburger shipped from China, right? And you can't get your hair cut, and there's just a million things that are untradable or non-tradable. And so what I'm trying to learn and trying to focus on is the idea that maybe the labor force maybe there's actually a surplus of people who can do the non-tradable work, right? And so even though we keep hearing about labor shortages, and those are real, if you're an employer, definitely real, at least in the US and probably in Canada as well. But it may very well be that the kind of labor that the jobs are available in are just not very productive. And so you can't pay more than $15 an hour because it's just not worth more in the market. And so that may be one reason why, labor value is capped. That's all I wanted to say.
Yeah, I hear what you're saying. I feel like sometimes nobody's willing to raise prices because we've got into a deflationary mindset. And the reality is that with globalization and with China beating at your door and with everything coming down in price, It's made it so we can't ever, like, no company thinks they can raise prices. So therefore, they never go and decide to compete by competing by like paying their workers more. And I've increasingly seen more politicians, and I just saw something about Quebec. That's a province up here in Canada,
right.
And there was a premier that said something to the effect is, you guys are all complaining about, or he's talking to the business community. He said, you guys are all complaining that you can't find workers. Well, why don't you try raising your prices? And I think that there's been like this kind of, I don't know, mindset shift, like that the reality is that nobody's had to pay up and compete for workers for so long that nobody's willing to do it. And the question I have for you is, what if we get into a situation with globalization going the other way, when all of a sudden it shifts and inflation does take off, even though Patrick tells us there's no way it can? Could you see a situation where next thing you know, people are competing to try to hire workers, and we do get that inflation that we seemed so elusive for so long? Like, what do you give the chances of that happening?
Yeah, I think that's a great topic, and I appreciate you asking it, because on many, when you look at, like Patrick mentioned, the debt load and the fact that, say, if there's just a normal sort of signal noise of defaults, then that could really bring down asset prices, or at least in terms of housing and so on. That's one factor. But we also maybe want to look at demographics in the context you just described, like what could cause labor inflation as well as, product inflation. In terms of labor inflation, a shrinking workforce would really do the trick. And that's exactly what we have in Japan. And now China's entering a demographic decline. Their workforce is shrinking for the first time in, decades. And the U.S. and Canada are escaping that only because we have really high immigration rates. But Europe, of course, is way down that demographic slide already. And so then if your workforce shrinks, then you really will have to bid up for labor, even at the lowest skill level. But I think another factor is, what can't be automated and what can be automated. And I talked about this in one of my books called Get a Job and Build a Real Career in a Bewildering Economy, because that was my attempt to provide some sort of advice to people that were entering the workforce or needed to do a midlife change. Was, well, you know what? There's different productivity, different valuation placed on different kinds of labor, right? And so clearly you're in a losing game with tradable stuff. If you're going to be making stuff that can be made anywhere in the world that's fully commoditized, that's going to be tough to do with labor, right? Because as you guys said, the labor's cheaper elsewhere. But if you can provide some kind of value that's non-tradable and that's very high productivity and so on, like specialty welding and stuff like that, these guys are getting big bucks. And my niece's husband is a specialty welder, and so he can work anywhere and earn a very good salary because his skill set cannot be automated. You can automate welding on a factory floor, but when you're going to crawl into the belly of some barge or something like that, sorry, the robot's out.
Right.
Okay, so Charles, before we wrap up here, I see that you are a musician. I go on your blog and I see you got some original music and stuff. So why don't you tell us a little bit about your musical interests, what you do and what you play? I take it you're a guitar player. Do you also sing?
Well, poorly at both. Yeah. If you listen to any of the recordings, you can tell I'm just, if there's 100 million guitar players, I'm in the bottom 5 million or whatever. But I have fun with it. And of course, I try to avoid that huge battle, that, it's like, it's almost like Democrats and Republicans or something, right? In the guitar world, you can be either, you play a Les Paul or you play, a Stratocaster, right? And so I like them both. Okay. I'm really sorry. I don't choose sides. My picture on the blog shows me with my Les Paul, which is a fine instrument, but I often play a Strat. So, okay.
I thought you were going to say acoustic or electric, because I'm an acoustic guy and I just can't get myself around. I try on the electric. I'm just a rhythm acoustic kind of campfire guitar player, so that's all I can do. But do you also do acoustic?
Oh yeah, I have a couple of acoustics, a Spanish and a Gibson. So no, I love acoustic. I usually play acoustic because then I have to fuss around with chords and don't worry about the neighbors banging on the wall or anything.
So what's your go-to campfire song?
Well, I would say Country Road or whatever the name of it is by John Denver.
Yeah.
And the reason why is a lot of people go, oh God, I've heard that a million times or so on. But if back when I first went to China in like 2000, which is almost 20 years ago, then that was the American song that was on a karaoke machine or that people knew in China. Now, of course, they're much more sophisticated and so on. So you could sing Country Road and everyone would, oh, I get it. Okay, I heard that. Yeah. What's yours? You probably have a much better one.
No, I don't know. I'm a big Beatles fan, so it'd probably be a Beatles tune. Or actually, I like Bob Seger. Seems to be like a lot of Bob Seger tunes are easy to play, and I find that's probably so. Maybe Against the Wind or something like that would be one of mine that I would choose. Something that doesn't take the just CG F or whatever it is. Something nice and simple.
Yeah, no, that would be a great choice. And whenever I hear a Bob Seger song, I always think, wow, that's really well crafted. It's like a classic hook and terrific lyrics. Those are good songs. Yeah. So
I don't play guitar, but if I am at a campfire, the one I always sing is Dennis Leary's "I'm an Asshole." It just feels so right for me.
Yeah.
No, come on. Yeah.
It's a great song. I love to sing it. It's
Well, that I think what we're if I can kind of broaden the thing we're talking about is like, that's one thing that a lot of people, including me, are worried about is, we're all worried about teaching our kids to code, like we gotta be technological marvels and it's all like, well, wait a minute. What about like all the other skill sets that are part of intelligence, right? And problem solving and, music and art and that kind of stuff are definitely part of our whole intellectual skill set, And so, yeah, it's part of being creative, I think is so important. I'm sure you guys do too. I mean, you need that break from staring at charts and reading economics and stuff, right? You bring a different kind of intuitiveness to it. I think it's really valuable.
Yeah. So Charles, I'll tell you, I played a little guitar as a kid, and then my daughter was learning, and she was in high school at the time, and she had the guitar teacher come over, and to do lessons. And I said, "Do you teach adults?" And he says, "Yeah, sure." And I said, "Okay, I've always wanted to do this," and I loved it because for an hour or whenever I was playing guitar, especially at the beginning, it took every piece of my concentration to learn to form those neuron paths and to learn the new skill. And I found that I would forget every, whatever the yen was doing or whatever, bonds were going up in my face. All those disappeared because I was learning this new skill. And I was actually kind of disappointed when I got good enough that I actually could think about my problems and actually play guitar.
No, I totally hear you. And in fact, I've been so frustrated by the inability, like my fingers just can't hit that weird chord and I'm like nearly weeping with frustration, right? But that's all good stuff. Well, the other thing is you guys living in Toronto, you've got nature relatively close by, right? And you've got a lot of places you can go where there's not a ton of people, right? I mean, I know it's a great city, but when you want to get out into the wilds, you got a lot of choices, right? And I think that's another thing that's undervalued. And I'm saying that I just came back from a 5-day camping trip in the Sierra, and it was all like, wow, this is so great. No Wi-Fi, And we camped.
What's interesting? I saw a study the other day about walking. And walking is obviously very important in terms of your health benefits, but walking in nature is actually one of the, it has a dramatically increased health benefit versus walking like in New York City, which I would have never imagined. There's something happens in your brain.
Yeah, that's great information. But we're not surprised, right? Because we're, why wouldn't we respond to nature as opposed to a noisy, smoggy city? Yeah. So what we're really saying, guys, is we're saying if you want to become a better trader, then take a walk in nature and play some music.
You got it. Well, Charles, it was a pleasure having you on. Why don't you tell everyone where they can find you again one last time?
Yeah, please visit me at of2minds.com. Lots of free stuff on the site. Lots of stuff to amuse and annoy you, and free samples of free chapters of my most recent books.
Well, Thank you. It was a pleasure. It was a pleasure meeting you, Charles, and we look forward to having you on again sometime.
I would love it. Thank you.
All right, cheers.
Thank you.
All right, Charles, that was great. Thank you.
Thank you very much, Charles.
Hey, you guys are terrific. I have to say, I've had I've been a guest on a lot of different shows, and I just love your guys' ability to hit the really good hard topics, but do so.
Lena, don't cut
informally.
this out. Leave this in, Lena.
That's very kind of you. Charles, you did a great job. I could tell it's easy with a guest like you because you obviously have done this before, and I could tell it was easy. You just point you in the right direction and you take off.
And having a beer or two helps too.
Oh, absolutely.
Right. You don't realize we're already half in the bag by the time we start this, Charles.
But it only gets better, Then we're gonna get more audience. Well, I had a list of 11 topics, so I was never gonna run out of something to talk about.
Okay. Anyways. Okay. Well, it was a pleasure meeting you. Thanks again, Charles.
Okay.
Thanks, Charles.
Thank you, guys.
Take care.
All right, cheers.
Okay.
Bye-bye.
Bye-bye.
Bye-bye. All right. Lena, jump on here. That was pretty good, wasn't it?
Yeah, that was pretty good.
So wait, beer time.
Yeah.
Oh, yeah.
Okay, so
I was
I'm gonna
almost
go.
choking on it earlier when you guys were like, "How is it?" And I had just taken a big gulp, and I was.
Come on, why?
Because I was in a hurry to catch up with you guys.
Oh
well, so I really screwed up taking all the half the beers when I should be splitting them 2-2-2 instead of 3-2-1.
Yeah,
so
no,
I
that was
apologize.
very selfish. That was very selfish.
Make it up to me at the rec room.
It was very selfish. I agree. I've learned my lesson, and the next time I will maybe change it. So now, in terms of rating this one, I am going to go high. I like this. This is a good beer. This is my kind of beer. Rye lager. I don't know what that means. Like they mix some rye in there.
Yeah.
I like it. It's good. Wayne Gretzky. We got Canada. It's really tasty. It's got no fucking fruit in it. So this is awesome. I'm going 8-9.
8-9.
That's your high score at 8-9.
Yeah, I listen. I don't give out I'm not gonna give out if I give out a 9.5, it's gonna be awesome.
I gave a 9.2 to
I know,
Fantasy
but you're
Factory,
easy.
right?
You're easy. You're too
come
easy,
on,
but-
that was a good beer.
Oh my God, whatever.
All right,
Okay,
Lena,
let's
Lena,
hear.
what do you
I don't
got?
care what Patrick says. Lena, what do you think?
I have to say this is my favorite beer out of all the beers.
Oh, exactly.
It's not as hoppy as any other beer we've had so far. It's nice and malty, and I like the can. It's all black and gray.
Okay, so what do you give?
I would
so
give
what
it
do
a
you got?
9.6. This is
What? Oh my God.
I would take a 6-pack and drink this by myself.
Nice. I like your
Wow.
style, Lena.
I'm not in agreement
I mean,
with you guys.
if I had the 6-pack, but
I know,
just
because
got
I
one, so.
kept it all. So Patrick,
Now,
what are you doing?
It's a very drinkable beer. I'll agree with that. But so is Carlsberg. All right, this is. I'm sorry. This is an incredibly. It's drinkable, but to me, it's not a beer that deserves something out of the spectrum of a middle of the road beer. I'm only giving it a 7.5, and I think Wayne Gretzky should stick to playing hockey. End of story.
God, that is awful. That is we're gonna go and pull your passport for that kind of shit, Patrick. Seriously, that's just crap.
This is a beer you could drink pretty much all day and
Yeah.
not feel like
Yes.
you've been
Yes.
drinking.
I did not actually not like the taste of the beer. It's just ordinary. It's I'm not
Didn't
gonna
you give some sour an
Didn't you get a
8.5
little
or
bit of
9?
flair?
Patrick, you are.
I
cut
gave an
off.
IPA. I gave an IPA a 9.
No, but
it
you
was
gave a
not
sour,
I did
an
not
8
give a
something.
sour a 9. I might have said something in the 8s.
IPAs are usually more hoppier than this beer.
This is Patrick.
Yeah, because it had flavor. It deserved a higher
Very
score.
disappointed, Patrick.
you, and then
Very
you're like,
disappointed.
Well, I'm sorry I didn't meet your expectations, but I am true to the scoring system, and I am a judge that goes by my taste buds. And this is an ordinary beer. It's drinkable, and I would have no problem drinking back a 6-pack. Just not gonna give it a high score.
Okay, well, that's what makes a market. Patrick, it's no surprise, and it's for those who don't realize this, we are not actually doing this on purpose. No. The fact that Patrick and I are disagreeing, we naturally seem to disagree about most things.
Oh my God!
Yeah, we have so much fun together. That's the part that's really like I
well,
find most
think
amazing.
think of how boring it would be if we actually agreed on everything. That there would be nothing to talk about.
Oh, I know. But Patrick, don't you know that you could just go out and talk to almost everyone on Zero Hedge because that's all that you agree with?
Yeah, but that's why they're so boring.
You're never going to get published on Zero Hedge if you say stuff like that. He's very sensitive. Tyler is very sensitive. By the way, I made this tweet storm. My new thing that I love doing. I love doing these tweet storms. And I put the point when not Tyler Jordan, but the other guy. I can't remember his name. But he's at his support meeting, and he's getting hugged by the
like with Meatloaf.
Yeah, and it's Meatloaf.
Yeah.
So Lena knows.
It's one of my favorite movies, Kevin.
I do.
Oh.
I'm a huge fan of Fight Club.
You know, when I was in high school, my girlfriends and I, none of us had boyfriends, so that's what we would watch together with a tub of ice cream and chicken wings on Valentine's Day.
Oh my God! Fight
like
Club.
4 years
That's
like
says
most
a lot. That says a lot about you, Lena. That just
no,
like
God,
all
like, I would have thought you would have been watching like Notebook or something like.
Oh no, I don't do chick flicks.
A tub of ice
I
cream
think chick
and
flicks
wings
set
and some Nope and
unrealistic
some Fight Club.
expectations.
That's
Fight
awesome.
So Lena,
Yeah.
how long before your girlfriend said you're just a weird chick and like we gotta find someone new?
I think like as soon as high school was done, okay, bye, never see you again, you know?
That's so.
But
Funny.
it's
So
all-
Fight Club.
one
So
of
you
my-
really like Fight Club. I didn't know that.
Yeah, I used to watch it religiously almost.
Oh, it's a
I
great
mean, it's
movie.
Brad Pitt and Edward Norton, you know?
Yeah.
Hey, so have you seen the new Quentin Tarantino?
Yes,
Oh, I
of
loved
course
it.
I did.
I love
And-
it.
and
I
you
saw
know
it
what?
last night actually.
Oh, did you? I can tell you this. You know how like I got and I had my picture taken beside Jon Snow there when we were in Chicago,
Yeah.
and I said you shouldn't do that. Like, you shouldn't stand beside someone that good looking
Yeah.
because it just makes you look bad. Remember we had this whole discussion.
Yeah.
Let's face it, Brad Pitt makes what's his face?
Leonardo DiCaprio.
Leonardo look like shit.
Brad Pitt is like he's like another species.
Yeah.
He just
I'm
looks
like-
good at any age.
Exactly.
Because he's also
I'm like,
badass.
People were talking about Leonardo's performance in that movie. I actually didn't find it that great. I thought Brad did a much better job. And I'm not the hugest Brad fan. Like I don't mind him, but I just I thought he stole the show. Like when he went to that, when he went to see the guy, the whole family at the ranch,
The hippie ranch?
the hippie ranch. I thought that
Don't
was a
give away
great
too
scene.
much. just in case
You're right. I won't say too much. But I thought that was a great scene. I loved it. I thought it was
It
great.
was a great movie. I watched it at a drive-in.
You know what? I didn't.
You did?
I didn't.
Whoa. Lena, you went to a drive-in?
Yeah, I went to a
Where?
drive-in to watch it.
Where?
In Oakville.
They have drive-ins in Oakville still?
Yeah.
I
There's
had no
one
idea.
It
I
was
would have
packed.
thought it would have
was
been up in...
packed.
Really?
Yeah.
Oh, that is wild. That is hilarious.
That's the type of movie you could see in a drive-in, though. You don't. Need
I don't
all
know.
of
You
don't need all that 3D shit.
You don't.
Patrick,
but,
I hate
know.
to tell you this. It wasn't in 3D, but
I'm saying you don't need that stuff. That's why a drive-in movie would be good for it.
I'm a little bit of a douchebag. I saw it at the VIP.
I saw it at the VIP.
Oh,
too,
if I was
so-
going to a regular theater, I would definitely go to a VIP. I can't sit beside certain people anymore in public.
So I went, and my daughter is 19, and so we brought her. My wife and I brought her, and she ordered some sort of fishbowl vodka drink. It was
Oh my
like-
God,
it
that huge thing!
it was
I know
bigger than my-
exactly.
it was bigger than my head, and like she drank it all.
So she was hammered. Like
know,
that's
she's
like that was probably 4 or 5 ounces of vodka.
I don't know, but I was just laughing because I was like, "Oh, she's a chip."
That's
off the
meant
old
to be
block.
shared between 2 people.
Is it?
Yeah.
Oh, well, she didn't view it that way.
It's great being 19.
Exactly.
All right.
Anyways, terrific movie, awesome, and Leonardo learned the hard way just what I learned, that you shouldn't put yourself beside someone that's that much better looking than you. You know that, interestingly enough, I heard that Matt Damon said the same thing, that he said that they would literally go out. It would be like Matt Damon, George Clooney, and Brad Pitt, like from Ocean's 11.
Yeah.
And they would go out and like they would literally go out on the town and they would be there and all the girls would be like, oh, it's George Clooney. Oh, it's Matt Pitt. And then they would see Brad Pitt and it would just be like, it was like
Matt Damon.
Matt Damon said we were like, a hunk of meat on the side. Like we just like they didn't want anything to do with us.
Brad Pitt is like I said, he's something else.
Yeah.
Have you seen the episode of Friends where Ross has named like 5 celebrities or something and laminated in a card, telling Rachel, if I ever had a chance to sleep with any of these people, these are the top 5, and that's a pass.
Oh, that's the funniest thing in the world. I always kind of laugh about that joke.
Well, I told Duke, and I said Leonardo DiCaprio and Brad Pitt, they're on the list. So
they're on the list. Okay, so here, let's be on one last thing. Everyone has to say their list. We won't do 5, we'll do 3.
I'm not saying I don't have anyone.
Come on, you got to have a list. So
I don't
Patrick,
have a
okay,
list.
so do you know what the list is? The list is, Patrick, I'm going to tell you right now. The list is you're allowed to have you meet somebody, you're allowed to have a one night stand with them. Your wife gives you the thing. Who are they going to be?
How about let me think about it and we'll do the answers in next week's episode.
Fuck that, Patrick. You got to say it.
I don't know.
Okay, so Patrick, I know Brad Pitt's on your list too. Don't lie.
What men?
Men, women, whatever.
Okay, so listen, I will joke. I got to tell you a story, Lena, because Patrick seems like he's no fun.
Oh my god.
I always joke in my writing about Lindsay Lohan.
Okay.
In my writing, it's like I literally always make
because you have a crush on her, right?
And
is she on your top 5?
I have this good buddy that's like he's like I saw him. I hadn't seen him in years, and then he started reading my blog and he started asking me about stuff. He says, listen, and literally I hadn't seen him in like 15 years, and we got together and he says, listen, there's a thing going around the work, and we're trying to figure out if like you're either really in love with Lindsay Lohan or if this is just like you actually think that she's gross. And there's varying bets, and we have to solve this. Because like I would always joke about her like in rehab and stuff like that.
Right.
No, she's on my list. I don't care. I'll be honest with you. She's on my list.
Okay, go for it. Name 3.
Lindsay Lohan, Belinda Carlisle, Kate Upton.
Ooh, Kate Upton's a good choice.
Okay, Patrick,
all right,
you gotta go.
No, okay, Lena, you go first.
You already know my 2, Leonardo DiCaprio and Brad Pitt. Ooh, the 3rd one. I gotta be careful about this one. I gotta think about the 3rd one.
Don't want to waste it.
Yeah, exactly. Don't want to waste it.
Did you see the Entourage episode when he slept with a woman and she was getting married the next day?
No.
You never saw that?
No, I don't.
Vinny Chase, he's like, he meets this woman, he sleeps with her in a hotel, and then he's like, can I see you tomorrow? And she's like, no. And she's like, and he's like, why? And she's like, I'm getting married tomorrow. And she's like, and Vinny's like, well, what? What? You're getting married tomorrow? Why didn't you tell me? He goes, oh, it's okay. You're on my list. And then he says, I hope that she doesn't meet, I don't know who it was. It was like some millennial actress. And he goes, she just said something like, I hope my husband doesn't meet Blake Lively or something like that.
Ooh, yes, Ryan Reynolds.
There you go. I understand that. Although I would choose Ryan Gosling ahead of Ryan Reynolds if I was you.
Ryan Gosling was great, but I think as far
he's
as
cooler than Ryan Reynolds. Ryan Reynolds is a good guy.
Okay.
Ryan Reynolds you want to marry, but Ryan Gosling is more like on your list. Patrick, you got to give us your 3.
All right. How about Kate Hudson, Jennifer Aniston, and let's say, and number 1 would be like Jennifer Lawrence or something. How's that? Does that make you happy?
So I'm happy with it. I just laughing about the Jennifer Aniston.
Well, back in the day, why not?
I get it. I hear you. I understand. I chose Belinda Carlisle, so what am I? Okay. Anyways, that's it. Let's call it a day.
I'm done.
We each gave our list.
We all found out who we want to sleep with. Great.
That's right.
Time to wrap up.
Glad my wife doesn't listen to the show.
Don't worry about mine. Especially this late in it, right?
All right. Good night, guys.